This is RateSpy TV, your covert source for Canada's hottest mortgage deals, strategies, and market intel.
You are watching RateSpy TV. We have one core mission, and that is to educate, give it to you straight, and help you get a better rate. I'm the spy, Rob McClister, and today's show is made possible by IntelliMortgage, the easiest way to get a mortgage online. Now, here's what's happening in mortgage land this week. Mortgage discounts have shrunk like a cheap t-shirt, but only for people putting down 20 to 35%. We'll tell you why. RateSpy.com has a new search tool for refinances. We'll show you how it works. And as is tradition, every week, the spy will use a high-powered microscope to analyze the hottest mortgage rate deals. Our lead story is incredible shrinking mortgage discounts. And no, we're not talking about a movie starring Rick Moranis. We're talking about people paying more for their mortgage. Since October 31st, the difference between bank rates for well-qualified borrowers and the lowest rates in the market has dwindled. This applies specifically to people with 20 to 35% equity. So here are two examples. Take an 80% loan-to-value purchase, for example. The best available discount on that mortgage type has diminished by 0.17 percentage points since October. On an 80% loan-to-value refinance, the best available discount has shrunk by 0.29 percentage points. For those of you without an abacus, 0.29 percentage points is $6,000 more interest over the life of a $200,000 mortgage. Now, this ain't no lunch money we're talking about here, unless, of course, you're washing down truffles at the Four Seasons with a bottle of Cristal. So why are discounts from bank rates shrinking? The answer is two things. For one, banks are actually being more competitive.
What you talking about, Willis?
It's true. They have cut their rates relative to 5-year swap yields, which are a proxy for what it costs them to fund a mortgage. Now, why are banks in such a generous mood, you ask? Well, it appears they're on a market share bender. It's also spring market, which is their best chance of getting mortgage business. In an effort to de-risk the mortgage market, the Department of Finance has eliminated default insurance on refinances and hiked the cost of most remaining insurance. In doing so, the Department of Finance has essentially forced higher costs on Canada's most competitive lenders who rely on this default insurance. Now, this is despite regulations already being the tightest in Canadian lending history. Now, higher mortgage rates are to protect us, the Department of Finance says. Well, if that's to protect us, then imagine if they're out to get us. The Pied Pipers in Ottawa are essentially leading borrowers with 65 to 80% loan-to-values right into the arms of the major banks. And we like banks, but we don't want to pay them more interest. The problem is, apart from higher rates, the major banks also have among the worst fixed-rate mortgage penalties in Canada. So if you compare fixed mortgage penalties at major banks and major non-bank lenders, the difference is stunning. And we're not talking about Charlize Theron in an evening gown stunning. We're talking a $4,500 difference between a bank mortgage penalty and a mortgage finance company penalty. Now, that's assuming a $200,000 5-year fix broken 2 years before maturity based on today's rates. Now, this $4,500 difference in penalties is equivalent to paying a half point more on your mortgage rate. So not only is Ottawa costing consumers more in interest, but it's costing some folks a lot more in penalties. So policymakers say, this is a trade-off for a safer housing market. Well, basically they're trading you more cost, and in return, they don't have to think of better ways to address the housing risk problem. Sounds like an even swap to me. In other mortgage news, RateSpy has a new rate tool. It's called Available on Refinances. It's a handy little checkbox, and you'll find it on all rate pages of the site. And what it does is show you which rates are available on refinances. And that's important because the lowest rates that you see out there are usually not applicable to refis for the reasons we mentioned earlier. In fact, for the first time ever, we are starting to see some major banks charge more for refinances. And that brings us to our trivia question of the day. Who has two thumbs and runs the only rate site in Canada with this feature? That would be the spy. In fact, the top rate comparison sites do not even tell you if a rate has significant restrictions. Their rates are about as transparent as Donald Trump's tax returns. In any case, we hope you like the feature. It's now time to do a little rate surveillance. We always start with bond yields because they are the rudder that steer fixed mortgage rates. Now, after jumping to new 2-year highs a few weeks ago, the 5-year yield has fallen back to earth. Canadian yields are falling around oil prices and U.S. yields like a celebrity stalker. If you're wondering when fixed rates will move next, grab some popcorn and watch the 5-year bond. For fixed rates to jump again, the 5-year yield will have to shoot above 1.33%. For fixed rates to fall, we need to see the 5-year yield dip below 1%. We're at 1.13% today. As for floating rates over the next few weeks, well, we expect them to remain flatter than Cleveland Cavalier Kyrie Irving's view of the earth. It's time to check out the mortgage rate stars and dogs. We begin with an old-fashioned term that fits risk-averse borrowers like a luge suit at the Olympics, the 5-year fixed. We saw some movement on the lowest 5-year rates this week, namely HSBC, the top banana in the 5-year market, raised its competitor-killing 2.35% rate up to 2.49%. Now, while there are many cheaper options for people needing an insured mortgage, 2.49% is the lowest refinance rate that we track here at RateSpy.com. Now, just remember that HSBC's IRD penalty is high, higher than the audience at a Snoop Dogg concert. HSBC's low-ratio mortgages are also collateral. That means that you pay more to switch lenders at renewal. And lastly, its maximum amortization is just 25 years. So if you need a longer amortization to lower your payments, you might be out of luck. Now, for folks who like a little more risk in their diet, 5-year variables are the place to dine. But that is only if you are getting an insured mortgage. You can snag insured variables for an unbelievable prime minus 1% right now, or maybe even better. Now, if you need an uninsured mortgage, then as Michael Corleone said in The Godfather, take the cannoli, leave the variable. You'll find the best value in a 2-year fixed mortgage instead. Just make sure you find one near or below 2%. Now that brings us to this week's Dog Pound. The dogs are rarely changing these days. Anything over 5 years is a great way to light your paycheck on fire and burn your money. And the 4-year fixed is also a waste of existence, given its similar pricing to the 5-year and its large premium over 3-year terms. Now, the one time where a 4-year fixed might make sense is if you have Nostradamus-like foresight and you know exactly when you're going to discharge your mortgage, and that happens to be 4 years. Now, if you're that prescient, you should probably know where interest rates are going too, so you might as well just become a trader, make $1 billion, and pay off your mortgage already. Now, the level of rate security for these terms just doesn't justify their extra cost, but like SPY always reminds fellow agents, the best term depends on your 5-year plan and your risk tolerance. So when going rate shopping, you want to balance the flexibility and upfront savings of a short term with the payment security of a long term. So that's our time for this week. Thanks as always for watching, because Sharp Spy's got to stick together. I'll be back in the same channel in 14 days with more harrowing rate tales. Until then, don't settle for a good rate when you can get a great rate. Every basis point counts. So the Spy's going to keep watching out for you.
RateSpy TV is sponsored by IntelliMortgage,
Canada's mortgage rate search engine.